everyone. Thanks for staying around after that last panel. Can we just do a quick audience? Well, first of all, this panel is 4 VCs, and they're 4 emerging managers, and they're going to be talking about what it's like to be an emerging manager and lessons learned. And but we would like to find out who's in the audience first. Can I see a show of hands? I assume you're all are entrepreneurs. How many entrepreneurs here are raising a seed or a pre-seed round? Don't be shy. How many? Okay, a little less, maybe a third. How many entrepreneurs are raising, say, a Series A? Any growth stage entrepreneurs in the audience? Any entrepreneurs looking to go IPO this year? No. How many investors are in the audience? Whether you're a VC or you're an angel investor? Okay. Okay. Well, thanks for coming. And hopefully the entrepreneurs who are raising the seed and pre-seed notice who just raised their hands. You 4, thank you very much for coming. I mean, let's just get right to it and talk about not just the throne chair, but kind of the topic du jour these days, and that is bubble talk, downturn. Let's just get right to it. How are you guys characterizing the current environment? Anyone want to leap right into it? How are things?
Okay, so our fund, Subtraction Capital, was a 2013 vintage fund. We were a little hot out of the gates, and I was worried about that, but it turned out prices went up a lot, like 2014, 2015. And so maybe it wasn't a terrible thing. They seem to be coming back to normal now, sort of, historical normals. I think there are a lot of funds from 2012, 2013 vintage that were new fund seed investing that aren't going to be a fund 2 for many different reasons. And so there just aren't as many checks being written out there in the space right now as well. So at least in the seed space, we can do a whole nother diatribe on late stage, but that's...
You said things are normal. What about the rest of you? Any thoughts? How do you characterize the current environment? Good, bad? Should we be chicken little? Should we be Pollyanna? Where do you guys stand on that?
So we kind of see it sort of a little bit differently in that we think it's a little bit more rational at this point. The ultimate realization, the last speaker was speaking about the progression of steps from starting a company to maybe IPO or acquisition by a larger enterprise, which also happens to be public. And the thing that I think we're starting to see today is this rationalizing of what it means to be public. And I actually said this to a friend a couple days ago, that when you go public, you're now analyzed by analysts who essentially work for my parents. They analyze for my parents' 401k, and they don't understand selling a shirt for $15 that costs $20 to make. And they understand spending $10 to sell a $15 shirt. That's something that every company does that's starting a business. So for us, we see that mentality trickling down to particularly the growth stage, which then has a very large pressure impact on what happens at the seed stage, because we recognize that if we invest in companies with just bad companies from the beginning that sell things for less than they cost to make and don't have a flywheel, that think they do but they don't, then we're going to have a hard time raising capital for those companies to grow. So I think VCs at my stage, that's early to A, seed to A, we're noticing that the growth capital is getting more challenging, which is forcing us, out of self-preservation reasons for the companies that we invest in, to be smarter about the types of companies we invest in. And we have about 135 investments in our 5 portfolios, and so we've had a chance to kind of see a pretty good perspective of what might happen. That's what we're seeing. A little more realistic, a little more like my parents would invest.
This is not your father's venture firm, even?
Yeah, I would agree with Zach. I think honestly the financial markets have fundamentally changed, and a lot of it is the macro environments have changed a lot. We have a lot of factors that are happening that's affecting the public stock market. I mean, we have a lot of the countries are struggling. We have a change in political administration. It's a very, very volatile time. It's definitely not very different than even a couple of years ago. So I think for us, like Zach, we're just a young fund, and we invest in seed. And a lot of the impact is really much more at the growth stage, and I think the seed stage is a little bit sheltered, a little bit more sheltered. But I think valuations are coming down to a more rational level, and I think that's good for everyone. I think for our fund, we've actually been waiting for this, and now we can actually do a little more bargain hunting, and I think overall it's a good thing.
I hear rational, I hear normal, I hear no freaking out.
Well,
I think it works.
we're more of a quant spot in terms of how we what's happening out there. First, different asset classes, risk asset capital class. I think from that economic indicator's point of view, the only alarming indicator is the interest rates that are heading towards negative territory. The exchange rate, that's been strong for the United States. Inflation, we don't have a problem with inflation right now, so that's good. But for the entire overall asset class, we do have influx to the asset class for venture capital. In fact, it's been better in the last several quarters than the previous 2 or 3 years. So as long as we have good influx of capital coming to the asset class itself, then it's good. But the problem starts happening when we start writing checks that are much larger vis-a-vis the capital that comes into the asset class, and that's sort of where the wave function starts breaking, and when we see the wave sort of starts breaking and crashing down to the shore. So we've been fortunate. I think it's going to get better because a lot of the institutional LPs are getting out of the hedge funds. And so hopefully that capital is going to trickle into venture capital asset class. And we've actually seen a good bit of that happening. So that to me is sort of what's happening at the macroeconomic level. And I'm actually excited about this time that we're in right now.
Cool. Well, that sounds very promising. I've never heard a VC anyway say that things are bad and that they're going to get out of it. It's a long-term venture that you're in. So these 4 are emerging managers, which means that they are investing their first or their second fund. Zach, you actually are a little bit beyond that, but you've rebranded your VTF Capital now. But as emerging managers, do you find it's easier to work with entrepreneurs? Do they expect more out of you than maybe a larger institutional brand name firm? What kind of experiences do you have working with entrepreneurs? Do you have to sell yourself more? Is it easier because you're more nimble and you can be a little bit more focused on the startup? How what's your experiences? I can call names, or someone can volunteer. Eva.
Yeah, sure. I mean, I think the VC world has changed pretty dramatically. I think deals that used to be done sort of in the ivory tower sort of way, where you could sit in your office and kind of entrepreneurs come to you and they sort of fall in your lap type of thing, is I think over. I feel like for VCs to win, and we see it actually in the actual returns. I mean, emerging managers are driving. I think a study came out from Cambridge Associates that emerging managers are driving a lot of the returns. It's not just the big firms. And I think, so I think to succeed now, the attributes needed, you have to be a lot scrappier. You have to be out there. You have to be where the young entrepreneurs are at the right events, and you have to do content marketing. You have to have a strong point of view. It's no longer sitting in your office. So I think times have changed a lot, and I think there's a lot of opportunity for young folks to be great VCs today.
Even though you're not in an ivory tower, you are in a throne chair.
Fair enough.
So actually, no one's in the throne chair. I think that's.
We'll anoint one of you at the end. We'll take a poll. Zach.
I think our view is, I think everyone. So essentially, venture capital firms are in a business. They have a product they sell to a customer. In one sense, the customer is their LP. In another sense, the customer is their company. And so, each firm. I think it's very important for any entrepreneur, for those of you that are raising, to have a very good sense of what the firm that you're pitching does and who they are. Not every firm is the same, and you want to be very clear about what your expectations are for the fund out there. I think, or for the firm you're working with. In our case, we have this internal mantra. It's actually pinned in a Slack channel. It's on a wall. It's something we talk about constantly. That our ability to raise capital is dependent upon our ability to drive returns and to have access to deal flow. Access to deal flow is dependent upon the contributions that we make to the companies that we're invested in. So all things then must point to our founders, and 100% of what we do is about supporting the growth of our companies and helping them grow directly. And a lot of that is just not published and never will be, and that's what we do. And then we talk to founders about that. We have to amplify that story. Our network is very strong, but then for other people that are at the growth stage, our network is not as strong for someone who's going from an A to a growth. You want to be able to step the role of the firm that you're working with, and that it's at the experience. So you might be able to sit in an office all day and make a whole bunch of phone calls as a VC, and that could be what your firm is all about. And you should be asking your firms that you work with what they do, because I think that's a big broad misconception in the VC world, is that every firm does the same thing. And they just don't. Some are hustlers, some aren't, and it's okay if we're just all very clear about what it is that we do. So yeah, we have to work hard, but not every firm has to do the same thing. You generally just should focus on what you're good at.
Paul, go ahead, jump in.
Sure. I just say at seed stage particularly, it's about people, right? Almost every company that you invest in is going to probably change their business model from when you have the first conversation with them. Unlike other stages, by the time you're at A, you've already got traction, you've got product market fit with some market. You might have some adjustments, but at seed stage, you're really investing in the people, and the people are taking you into their team. And you're going to be their earliest institutional investor team member in most cases. So it's more relationship. Like at Subtraction Capital, we take it quite literally. We say we invest in companies that if the fund went away tomorrow, one of us has to be able to raise our hand and say, I would love to be working in that company if we stop being a venture capitalist tomorrow. So think about a job interview. It's about people.
Yeah, I agree. I mean, just from my experience, I used to go to a lot of hackathons. And I love hackathons, and all of the hackathons that I went, I've never seen one single VC associate or anything from any one of those billion-dollar-plus VCs. And the very first check that I wrote was at a hackathon, and it was acquired by Google. And so I think all of those levels are great places to meet people. And I would encourage any entrepreneur, investor, angel investor, whoever, go to hackathons, go to demo days. I think it's got a large social component of it. It's not all social. Of course, you have to sit down and do the math, but it is highly social, especially in pre-seed.
Matt, you went to a hackathon. Eva, you were talking about content marketing. What else do you have to do? Do you have to sell yourselves a little harder? Do you have to blog more, tweet more? I mean, what else do you have to do to make yourself known to the entrepreneur when you're looking for deals?
Well, I guess let me wrap up by just adding
Sure.
to that question. I think, if you have something to say it. Whether that venue's writing for TechCrunch or writing for, on Medium or anywhere else. Of course, I think you shouldn't be afraid to just say what your thought is. Hopefully you have one. And in terms of selling, I don't agree with hustling throughout the process. We don't hustle. We don't elbow anybody out. We look at it a straightforward way, and I think that's what the entrepreneurs are looking for these days. They've heard every truism that's out there. That's really not what they want.
Eva, go ahead.
Yeah, just really quickly to add to that. I mean, it's no different than running a startup where you have to build a brand over time, a brand for yourself as well as a brand for your firm. There are lots of different tools that you could use, and everybody has a different style. I guess for me, it's really just trying to be authentic, because you could create whatever story you want, but if it doesn't fit you, it'll just come across wrong. And fundamentally, for you to have a success in follow-on funds is really your founders vouching that whatever you said you're going to do, you actually do. So I think founder references end up being the most important, so you just have to be able to do your job well there.
I would just argue absolutely in support of that we've generally found, as we've thought about it, that there's an inverse correlation between noisiness and channels and media and fund and portfolio performance. In other words, if you spend most of your time doing that, you're probably not doing something internally. There's an argument to be made that distributing your knowledge is more powerful than doing it internally one-on-one, but overall, we feel like you have to take I feel personally like you have to take a long-term view that if you do everything you can to support the growth of your portfolio, then the numbers and the performance and the exits for the benefit of the companies and the employees will begin to speak for themselves. We've generally received the majority of our strong referrals in companies we've ultimately invested in, and the companies that have ultimately performed the best have come via introductions from our current or past portfolio and our founders. And that's just what we've also been told by just people that we know. Of course, our data set's limited to that. That is typically is the greatest, the strongest channel of support. So, that's how we see it, that if you spend 90% of your time working on things that empirically speak to your ability to perform rather than your written sort of justification of your work, then it's quite possible you could end up being a better VC. It's just a longer term game.
Yeah, I would agree. Same.
You guys don't have to agree with one another.
Well, but on this one, it is
Yes.
like the referrals are it. I was just talking about it. This is a relationship you're starting, and it's hard to start a relationship with somebody you bump into on the sidewalk. It's much
Or
more
at a
likely.
conference.
Well, it's hard. It is. It's hard. It's much more likely you're going to start a relationship with somebody who you were introduced to by somebody that you already knew well.
It's a crazy factor. It's like if you send me an email, I don't know you. I'm like, it's totally possible you're an axe murderer. Really, that is potentially.
Let's hope not.
No, but I mean, the possibilities of your being an axe murderer are greater than zero. And until proven otherwise. And so I run the risk of being killed if I meet you. Now, if you introduce me to somebody, there at least is one data point that says, okay, Alastair doesn't think he's crazy. So
No,
he would,
I didn't ask that audience
that's-
poll question.
Yeah,
but
so
we could.
no, it's true. It's true, right?
Right.
And like it's such a rigged game in that sense. I think because most VCs won't take unsolicited pitches, which sucks. And it's something that we've tried to fix ourselves and then had very bad success or no success at. But I think it's constantly it's a limiter all for encouraging diversity and investing because we don't meet people unless they know people. So it's basically our ability to have a broad reach is limited to the power of our network, which is kind of a weird connection point.
Would any of you ever join a large firm? Or you're going to be doing these, yes, I guess rather small size. Go ahead, Paul.
Yeah, sure. I mean, for me, I started with what is my dream job? How do I want to spend my days, right? And I was having more fun. I had been an operator for 15 years, 7 years coding at Boeing before there was an internet. And I was having more fun helping my friends start their companies on nights and weekends than I was in my day job, right? And I was like, how can I make that my day job? And so I started from, I want to drive to one company in the morning, and at lunch, I'll drive to another company. I can do that Monday through Thursday and get to 8 companies a week. Now, might it be possible to build a fun strategy on top of my dream job? And will it work? And that was a hypothesis 3 years ago. I could say today, I think it works. I can say today, I'm in the most fun job that I've ever had in my life. So I think I'm good.
I would agree from looking at it from my point of view. Well, I would love to ask more about deal flow and other questions. Are there any questions in the audience? No axe murderers, please. Yes, sir. The investor from New York, yes. Okay. Yes, you have a question.
So I'm going to jump on that question before you finish it. That is entirely a Shark Tank phenomenon. This concept of I'll take 5% of your company for $100,000 or whatever. There's two causes to that. One is YC, and it's a specialized program, and the other is Shark Tank. And I think you have to realize at the seed stage, if you're actually in the game, you have this. You don't really have the ability to set the economics in a reasonable way because typically at our stage, the business doesn't have an easy way to determine, what the PE ratio is, or are we trading on, are we buying, 7x future earnings or XYZ of EBITDA, and so the numbers are going to change from company to company. So to apply a global standard to it without having the program that YC has is very, very challenging.
Because of shows like Shark Tank and YC and what?
Well,
I'm not like a politician. I'm actually saying, I reject your question. I don't think it's a rational or reasonable question. Right.
I want to be mindful of our time here. Did you have a
So
quick
let me-
question?
Yeah, that's,
Yes.
Yeah, let me sort of add a few things to this.
Okay,
What
we're running out of
Zach
time,
said,
but go ahead, Matt.
I think, it makes a lot of sense, more so probably, within the context of what's going on here. I will tell you though, if you're getting Silicon Valley deals, they couldn't find the money in Silicon Valley, I wouldn't get on that deal to begin with, because if they were any good, we would invest right here. By the time they make it to the East Coast, it's, come on.
yeah, and a 3% deal.
Can-
a guy that's got
can-
3% of his company, something
I mean,
terrible has
I
happened
can
in the
continue with a
past.
certain decorum if that's okay with you.
Yeah, please.
Okay. The other part of it is, if we look at the equation from the other side, let's say we take a certain percent out of a firm. The way I would look at it is, what percent of this firm is still enticing enough for its co-founders for them to stay dedicated to the firm? And we've seen, there are some examples that there are some phenomenal co-founders that really got diluted to around 4 to 5%, and they're still doing a great job out there, but it's very, very rare. Other than that, on a per round, if they're giving up anything more than 15 to 18%, after 4 rounds, they're going to be down to nothing. And you don't want to Shark Tank your way the way they do it on the show, unless I would do it. There are certain exceptions to it. If it's a licensing deal, if it's a dividend deal, if it's a cash flow, recurring cash flow type of situation, then you can figure out some sort of it's more of a financing arrangement. At that point, you're a banker, you're not a venture capitalist. And so that's more of a banker way to look at it. So on that deal, I have to try to figure out whether it's, I didn't say they're not. I didn't
Yeah,
say there
exactly.
aren't. I didn't.
I think we're getting
didn't
off
dispute
topic
that.
here, and we're running out of time. I do respect the question, and thank you very much. However, we are running short on time. I knew this would go quickly, which is why I dispensed with the introductions, but this was very educational. I learned a lot. Thank you for being a great audience, and how about the panel? Thank you very much.